Quo vadimus. Where are we going? In episode 4, I said that speculation is theft, and I promised my solutions. I'm not a communist. I don't believe in full state ownership, but I do believe that usury is a secular sin. I'm a fervent supporter of capitalism, but the system we've allowed to develop isn't actually a capitalist system. I've spoken before about John McMurtry's biological model of the economy, and his opinion that the type of corporate capitalism we've allowed to develop is actually the equivalent to economic cancer. Massive, useless, and detrimental growth that our society's immune system, for some reason, doesn't recognize as unhealthy. The basic idea behind capitalism is that, after paying all my expenses, I have excess wealth. You want to start a company, but don't have the capital to begin. I choose to invest my money with you. With my money and the money of others, you found your company. Your company produces a product and turns a profit from its sale. You share this profit with your investors in proportion to the amount of money we've invested. Everyone benefits. You have your factory and see the fruits of your labors flourish while receiving financial remuneration for your effort. Your factory creates jobs and products that the population needs. Your investors see their money grow. It's a good system, but that's not the system we have. Describing the many intricacies of the stock market would require a nearly infinite amount of time and expertise, neither of which I have. But I don't need to describe it in full detail to outline the underlying problem. As a company, you issue stock to your investors. The problem is that that stock can be traded, and its value fluctuates above and below the amount of your initial investment, which allows for speculation. I can buy stock for, let's say, $100. Then, in a week, I can sell it for $120 because, for a whole bunch of reasons, its perceived worth has increased by $20. But how has it increased? The company I've invested in doesn't now have $120 of my money, or 120% of the assets it did a week ago. If it's made that much profit, shouldn't I have been paid a dividend of $20? This is a gross oversimplification, but when I sell that stock for a profit, I'm stealing $20 from the guy who buys it. It's like gouging customers in a time of emergency. There's an old saying in real estate, a house is only worth what someone will pay for it. But what someone will pay isn't connected to actual worth, but to perceived worth, and as I showed in my advertising episode, our perceptions can be manipulated. The extent to which perceived value is manipulated on the currency market, on the stock market, and on the commodities market is astonishing. It's easy when you have enough capital. If something is being bought up quickly, it makes other investors assume it's a worthwhile stock. So, they buy it as well, which sends the price higher and the original investors sell it off at these higher prices before it can drop. What's really perverse is that these same behaviors are allowed to occur on the international currencies market, and these fluctuations in the value of currency can have terrible effects on the nations whose currency is being traded. What solutions can we come up with then? We could develop complex regulations which seek to rein in the practices, but that are difficult and costly to enforce. Or we could address the actual problem. How do we allow for investment without speculation? My solution is rather simple. We create one system of investment that is easy for everyone to understand and participate in. Equal opportunity to investment is necessary because if only the wealthy can invest, and investments on the whole are profitable, then the gap between rich and poor is doomed to widen. It's a problem of scale, and that's something I'm going to speak about again soon. The biggest deterrent to investment by the poor is the complexity of the market. I'm not saying the poor are dumb, but that given the way things are now, a healthy portfolio requires a great deal of attention and know-how, often purchased know-how. If I have $10 million to invest, then the returns on that amount mean that my time invested will be worthwhile. For instance, 2 hours a week devoted to my stocks, 140 hours a year, resulting in a $100,000 gain in my investment, works out to about $960 an hour for my work, and that is only a 1% return. Whereas if I invest $1,000 and get a 1% return of $10 for my 104 hours invested, I'm earning 9.5 cents an hour, and would have been way ahead selling lemonade in front of my house. The system I have in mind would be simple and easy to use. Another advantage to simplicity is that it makes cheating very hard, as there are fewer rules to break or bend. My system is a cross between stocks and bonds. The investor purchases stock in a company for a set period of time, like they do now with bonds. But rather than being paid a predetermined interest on their bonds, they are paid dividends in proportion to the size and term of their investment. At the end of the investment period, the investor receives back the amount of their initial investment. This isn't usury because the payments are shares of profit, and the initial investment isn't a loan. At the end of the term, the company isn't paying the money back, they are buying back their share in the company. The assumption with this system is that, say you invest $1,000 for 10 years. On that $1,000, you earn shares of the profit equaling, let's say, $250. The company has been squirreling away its profits and reinvesting in the company, so that at the end of the 10 years, when you buy your stock back for $1,000, if they haven't saved up that much, they could sell further stock or convince you to rebuy it for another term. If the business has been so unsuccessful that neither option is available, then they shut their doors and sell their assets to meet their agreement with you. Yes, occasionally investors will lose some or all of their money. That's the way things go. All investment carries risk. This system would have many benefits, not the least of which is that stockholders would be far more active in ensuring the long-term health of their company, so that they will be more likely to receive the initial investment back. This will create a healthy balance between paying out dividends and maintaining corporate health. Short-term economic thinking is bad for the economy, for society, and for the environment in ways that I will outline in further episodes. Such a system would eliminate stockholder apathy, which has led to the huge problems we're seeing with executive compensation. This system would eliminate hostile takeovers and allow a company's founder to buy back their company by simply not issuing more bonds after they've expired and been repurchased. There is investment, but there is no speculation. Investment occurs over long periods of time, and momentary uncertainty about a company's prospects wouldn't lead to panicked sell-offs, nor would market bubbles be created. There are disadvantages, yes. Mutual funds would either be eliminated or have their structures drastically altered. This isn't a huge problem really, because mutual funds and other similar structures are at the heart of stockholder apathy, and often invest people's money in enterprises which the individuals would never even consider because of the ethical ramifications. Another objection would deal with the impact on pension plans, and I'll deal with that in a later episode. Yet another objection would be that such an investment scheme would make it very difficult for a company to grow to the size of many of the multinational corporations we have today. This objection is actually the biggest advantage, but there's more on that to come next time. I know my ideas aren't perfect. Don't shoot me down, make suggestions. My name is Colin Jones, and I want things to get better.